I'd like to start by talking a bit about Foord, the business. It's been in existence for 37 years now, which is incredible. What's changed over that time and what's evolved in Foord Asset Management?
Actually, very little has changed. We set up the business to manage money and not people. We kept the number of people in the business pretty small. We've got just over 40 people in the SA operation, which is quite small considering how much money we're managing. And in the international side, we've got about 10 people managing there out of Singapore. Not much has changed over the 37 years. We still have our style independent, don't put us in a box type management, and we manage risk. And the risk comes in all sorts of forms, but it definitely doesn't come in terms of volatility as far as we're concerned.
One of those key things that you mentioned or you touched on just then is focus, and not deviated from your investment philosophy, process, or mainstream business, which is investment management.
We said when we opened our doors that we are going to have only one product, and that's our performance. We've always seen ourselves as an investment house as opposed to an equity house, and that's because we focus on the enemy, and the primary enemy of investing is inflation. So inflation plus is what our investors should be seeking, and that's what we try and do. And we learned very early on that the asset allocation decision is the most important decision that needs to be made. Selection probably makes up 20% of the difference in returns, and asset allocation makes up about 80% of the difference in returns. Selection is important, but asset allocation is more important.
You mentioned you've kept the team fairly small, but one thing you have done is purposefully separated investment management with the operational part of the business.
Investment side has always been separate. So I'm the Chief Investment Officer, both locally and internationally. And locally we got Paul Kluwer as the CEO, and before that there was Chris Kraling. So for over 20 years we've had the operational side completely separate to the investment side. So there's Chief Investment Officer, there's Head of Company Research, and there's portfolio managers and analysts involved in the investment decision. And then the operational side running the business, the people, that all falls under the CEO. And we've got the same thing in Singapore. There's a CEO, and I'm the Chief Investment Officer there, and the portfolio managers and the analysts report separately there.
As you say, you've transitioned in from a boutique managing a smaller amount of assets into one of the largest asset management groups in South Africa. How has that been? Has that been difficult?
It's interesting you say that. We still see ourselves as a boutique, and we're trying to manage assets and not gather assets. And it's more important to us to put the score on the board, get the right return for our investors, rather than measuring ourselves on the size of assets. And that was our focus at the beginning, and it's still our focus now.
And then with the recent industry woes, with asset classes not providing returns, that do be inflation or more prominently cash. Investors, planners, asset managers are under pressure to beat cash on a regular basis. We've seen a slowdown in flows last year. Is that something that's causing concern at Foord?
It's something we've seen before.
Right.
In our early days of managing money, if there was a downtime in the market, somebody would say, well, we could have got that return in the post office, looking backwards and things like that. It's still here. Long-term equities are the asset class of choice. They will produce inflation-adjusted returns because companies can grow their earnings, and those with pricing power will grow their earnings faster than inflation, and that will beat money in the bank. What's happening globally is interest rates are very low, and therefore returns are low, particularly from the base that asset prices got to. We've always believed that interest rates are a key determinant of valuation, and low interest rates lead to high valuation. So from the level of high valuation that we've had over the last few years, it's going to be very difficult to get meaningful returns going forward. But in the South African situation, we've been actually quite lucky that cash hasn't been earning nothing like it has overseas. Cash is actually earning more than inflation. Now you have to take, for the man in the street, he's got to take his tax off that. But in the fund, to be able to get inflation plus 4, inflation plus 5, as we have been able to do sometimes in money markets, sometimes in bonds, it's a far better real return than managers have had choice of overseas. And we've taken advantage of that in the stable fund. It's a lower risk return, achieving almost the benchmark. So it's tricky going forward. Returns are going to be lower globally. until interest rates pick up. But you've got an anomaly in South Africa that both nominal and inflation-adjusted cash returns are higher than they are in the rest of the world, and that's a competing asset class. We think the people going into it may benefit for a year or two, but in the longer term, it's not going to be as good as a properly managed asset allocation fund.
And again, that's something that you focused on as a business, is managing balanced portfolios from 1983, I think. Why did you take that decision and not just focus on equities, for example? Why was it important to have balanced portfolios?
For the reason that we see ourselves as asset managers trying to beat inflation, as mentioned earlier, and equities are cyclical, and by broadening your choice of asset classes, you reduce risk. One of the few free lunches that are out there is the diversification. Diversification can increase returns. It can also reduce returns if you do too much diversification. But properly managed diversification reduces risks and increases returns over time. And we've proved that, and that's what we believed in 1983, and that's what we've been able to do both globally and locally, is prove that the asset allocation does benefit the fund, both from a risk point of view and from a return point of view.